You wake up tomorrow morning, check your mailbox, and find an envelope from the IRS that doesn't make your heart skip a beat for once. Instead of demanding more money, it's actually telling you that you'll be keeping more of what you've already earned. For millions of Americans over 65, this scenario might become reality sooner than you think. After decades of watching your hard-earned dollars disappear to taxes while living on fixed incomes, the United States Senate has just said something remarkable. It's time to give our seniors a break. If you want to stay informed about financial changes that could put real money back in your pocket, hit that like button and subscribe to the Golden Money right now, because this story is just getting started. What we're witnessing right now in Washington represents one of the most significant financial developments for older Americans in recent memory. The Senate Finance Committee has just unveiled their version of what's being called the One Big Beautiful Bill, and buried within its pages is a provision that could fundamentally change how much money seniors get to keep from their retirement income. This isn't just another political promise that gets forgotten after election season. This is real legislation, with real numbers, affecting real people who have spent their entire lives contributing to this country. Let me paint you a picture of what this actually means in everyday terms. Meet Dorothy, a 67-year-old retired teacher from Ohio. She worked for 35 years in public schools, never making a fortune, but always doing her part. Her pension brings in about $40,000 a year, and she receives Social Security benefits that help her make ends meet. Under the current tax system, Dorothy pays federal income tax on a portion of her retirement income, leaving her with less money to cover her prescription medications, her monthly grocery bills, and those unexpected home repairs that seem to come up more frequently as the years pass. Dorothy represents millions of Americans who find themselves in similar situations, watching their purchasing power shrink while their expenses continue to climb. The Senate's new proposal would provide Dorothy, and millions like her, with what they're calling a bonus deduction of up to $6,000. This isn't a one-time payment that arrives in the mail and gets spent immediately. This is a permanent change to how the tax code treats seniors, reducing their taxable income by $6,000 every single year. For someone in Dorothy's situation, this could mean saving anywhere from $600 to $1,500 annually in federal income taxes, depending on her tax bracket. That's money that stays in her pocket, money that can go toward the rising cost of healthcare, the increasing expense of maintaining her home, or simply providing the financial security that every senior deserves. But here's what makes this proposal even more significant than it might appear on the surface. This isn't just about the standard deduction that seniors already receive. The current tax code already provides an additional standard deduction for taxpayers over 65, which amounts to about $2,000 for single filers and $1,600 for each spouse on a joint return. What the Senate is proposing goes far beyond this existing benefit. They're talking about adding $6,000 on top of what's already available, creating a total additional deduction that could reach $8,000 for single seniors and potentially even more for married couples. The timing of this proposal isn't coincidental. We're seeing this legislative push at a moment when seniors across America are facing unprecedented financial pressures. The cost of prescription medications continues to rise faster than inflation. Healthcare expenses are consuming an ever larger portion of fixed incomes. The price of basic necessities like food and utilities has increased dramatically over the past few years. Social Security benefits, while they do receive cost of living adjustments, often fail to keep pace with the real-world expenses that seniors face every day. Consider the case of Robert and Martha, a married couple from Florida who both turned 66 last year. Robert worked as a mechanic for decades before retiring, while Martha spent her career as a nurse's aide. Together, their retirement income from pensions and Social Security totals about $60,000 annually. They own their home outright, having paid off their mortgage years ago, but they're finding it increasingly difficult to manage their monthly expenses. Their property taxes have increased, their insurance premiums have gone up, the cost of maintaining their aging home continues to climb. Under the Senate's proposed legislation, this couple could potentially reduce their taxable income by up to $12,000, since the deduction would apply to both spouses. For them, this could translate into tax savings of $1,200 to $2,400 per year, money that could make the difference between just getting by and actually having some financial breathing room. The legislation doesn't stop there, though, and this is where the story gets even more interesting for seniors who are paying attention. The Senate version includes provisions that would phase out this deduction for higher-income individuals, ensuring that the benefit goes primarily to middle-class and lower-income seniors who need it most. Single filers with incomes above certain thresholds would see the deduction gradually reduced, and it would be eliminated entirely for the wealthiest retirees. This targeted approach recognizes that not all seniors are struggling financially, but it ensures that those who are facing genuine hardship get the help they need. What's particularly noteworthy about this development is how it differs from the House version of similar legislation. While the House of Representatives had proposed a $4,000 additional deduction for seniors, the Senate has gone further, recognizing that the financial challenges facing older Americans require more substantial relief. This difference between the House and Senate versions means that negotiations will be necessary to determine the final amount, but it also demonstrates that there's bipartisan recognition that seniors need and deserve additional tax relief. The political dynamics surrounding this legislation are worth understanding as well. This isn't a partisan issue where one party is fighting against the other. Senators from both sides of the aisle have expressed support for providing additional tax relief to seniors, recognizing that this demographic represents a significant portion of their constituents and that many older Americans are genuinely struggling to maintain their standard of living on fixed incomes. The debate is more about the details than the fundamental concept, with discussions focusing on the size of the deduction, the income thresholds for phase-outs, and the duration of the benefit. From a practical standpoint, if this legislation passes, seniors wouldn't need to take any special action to claim this deduction. It would be built into the standard tax forms that people file every year, making it as simple as checking a box to indicate that you're over 65. For seniors who use tax preparation software or work with professional tax preparers, the benefit would be calculated automatically. This simplicity is intentional, recognizing that many older Americans prefer straightforward solutions rather than complicated programs that require extensive paperwork or special applications. The economic impact of this legislation extends beyond individual families, though that's certainly the most important consideration. When seniors have more money to spend, they typically spend it in their local communities. They shop at local grocery stores, they eat at neighborhood restaurants, they hire local contractors for home repairs, and they support local businesses in countless ways. This means that this $6,000 deduction doesn't just benefit the seniors who receive it directly. It also provides an economic stimulus to communities across the country where these seniors live and spend their money. But here's the crucial information that every senior needs to understand. This legislation is still working its way through Congress, and timing matters enormously. The proposed deduction would begin with the 2025 tax year, which means it would affect tax returns filed in 2026. However, for this to become reality, both chambers of Congress need to pass compatible versions of the legislation, and any differences between the House and Senate versions need to be resolved. This process can take months, and there's always the possibility that negotiations could change the final details. This is why staying informed about developments in Washington has never been more important for seniors and their families. The difference between a $4,000 deduction and a $6,000 deduction might not sound dramatic, but for someone living on a fixed income, it could represent the difference between financial stress and financial security. For couples like Robert and Martha, it could mean the difference between worrying about every monthly bill and having enough cushion to handle unexpected expenses without panic. The resources for staying updated on this legislation are readily available through official government websites, reputable financial news sources, and organizations that advocate for senior citizens. The Senate Finance Committee maintains detailed information about tax legislation on their official website. Major news organizations like CNN, CBS News, and financial publications like Kiplinger provide regular updates on the progress of tax bills through Congress. Organizations like AARP actively monitor legislation that affects seniors and provide easy-to-understand explanations of complex tax proposals.